Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of July, with the majority of economists expecting inflation to have further cooled. We got our answer at 8:30 this morning when inflation did in fact come down, now sitting at 2.5%, leaving the door open for the Bank of Canada to cut rates in September.
The time is now.
Indeed, and as we'll see today, it's not just headline inflation that is looking good, with measures of core inflation, those measures which the Bank of Canada actually cares about, also showing signs of easing as well, again, leaving the door open for more cuts coming from the Bank of Canada. Yet some, including David Rosenberg, are saying that the Bank of Canada is not going fast enough, that it's going to have to cut more aggressively, lest inflation go to zero.
If they don't move quickly, then we'll be talking in the next 2 years of inflation going to zero.
Oh no. Oh no.
Indeed. But, as we'll see today, that's really not something that the Bank of Canada wants to see. Even more so, it really doesn't want to see deflation, price decreases. So what I want to do today is go over Canada's inflation data for the month of July, take a look at Rosenberg's argument that the bank really doesn't want to see deflation, and then discuss some implications. Whether or not today's data will be enough for the bank to deliver its third rate cut this year at its announcement on September 4th remains to be seen, but we'll obviously cover that announcement and the press conference held thereafter on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. As mentioned, Canada's inflation rate continued to trend downward in July, coming in at 2.5%, its slowest increase since March of 2021. Mortgage interest costs, rent, food from restaurants, auto insurance, and property taxes were the biggest upward contributors to Canada's CPI. While the CPI was pulled down by telephone services, car prices, computers, travel tours, and home prices falling. So, as with previous months, so long as you don't need a place to put your phone, your car, or your computer, you're all set. But the really good news is that measures of core inflation, those measures which the Bank of Canada cares about when deciding the path of interest rates, fell as well, with CPI median dropping from 2.6 to 2.4 and CPI trim dropping from 2.8 to 2.7. And that's definitely a good sign, especially since for the past 2 months, we've seen somewhat of an acceleration in both measures of core inflation. So, those two measures moving downward is obviously going to be good news for the central bank. So, overall inflation heading down, now sitting at 2.5%. Core measures of inflation also reversing some upward trends that we've been seeing over the past few months, all nearly sealing the deal for a Bank of Canada rate cut in September. With that said, before moving on, I think many would disagree with the idea that inflation is sitting at 2.5%. Looking at the detailed stats, food price growth is only sitting at 2.5% from 1 year ago, and any trip to the grocery store will tell us exactly what to think of that statistic.
Bullshit.
But I digress. With inflation coming down, predictions have been coming in as to how far the Bank of Canada will have to cut rates, how low rates will have to go, given the continual reports of a weakening economy. According to the Bank of Canada's Market Participants Survey, updated in early August, we could be sitting at a 3% policy rate by this point in time next year. But, as mentioned earlier, David Rosenberg, in an interview with Bloomberg, says that the Bank of Canada may have to move quicker if it wants to avoid 0% inflation. Now, granted, Rosenberg has been calling for rate cuts since Moses wore short pants, predicting 10 out of the last 2 recessions. But that doesn't mean that he's wrong about the bank's thinking vis-a-vis deflation.
Their concern is that inflation will fall below 2%, their target. They do nothing, inflation is going to zero in the next 12 to 24 months.
And Rosenberg's sidekick, Ed Devlin, who appears with him on a regular basis on Bloomberg, summed up the bank's concern with deflation quite well.
Disinflation or deflation, okay? And the reason why it's just insidious is because we've got so much debt. We've got massive debt stocks, both on the government side as well as on the consumer side. And when you've got inflation at 0 or less, it means when you pay back your debt adjusted for inflation, it costs you even more. So you're not inflating away your debt, you're increasing your debt stock.
So what Devlin is saying is that the central bank doesn't want to see deflation, prices actually decreasing, as if they did, that would make servicing already incurred debts even more expensive, as prices decreasing lead to a downward pressure on wages and productivity, as even noted by the Bank of Canada. So the argument is that if prices were to actually fall, that would lead to a decrease in production, as why invest in production if you know the price of goods is going to fall over the next year or so, which would in turn lead to lower wages, making those debts that Canadians have already incurred, the government and households alike, even more expensive to service.
I am looking out for you in this thing, okay?
And it's not like Rosenberg and Devlin are pulling these ideas out of thin air, as the bank has even cautioned against the deflationary debt spiral in previous publications. And Rosenberg and Devlin are making the point that the Bank of Canada cannot allow this, that it needs to lower rates lest the bank see prices fall, which could and would lead to Canadians being unable to pay the debts that they've already incurred. As such, the bank needs to lower rates so Canadians can take on more debt to help sustain those prices.
I got a good feeling about this.
And yeah, that's a decent point. Try going to CIBC, your mortgage holder, and telling them you need a visa, or you won't be able to pay your mortgage. So, let's just be clear about the argument being made by Rosenberg and Devlin, and really the Bank of Canada. If the bank does not make it easier for Canadians to take on more debt, then they won't be able to sustain prices, which will make it even more difficult for Canadians to pay off old debt.
Don't you mean Ponzi scheme?
Regardless, is Rosenberg correct about the speed of which the Bank of Canada needs to cut rates to prevent a deflationary spiral? No one really knows. We are seeing the economy weaken, and it appears as though that weakening economy is showing up in our inflation data, though probably not as much as that which is being reported by Stats Canada. If inflation does in fact continue to come down amid a weakening economy over the next couple of months, then yeah, I think the bank will continue to cut, in part, to prevent that deflationary spiral. As we've discussed on this channel since the beginning of the rate hikes in early 2022, when the bank does eventually enter into that rate cutting cycle, which it appears to be in as of right now, it's not doing so because something good is happening. It's doing so in order to save the economy. How that economy will fare remains to be seen, but we will obviously continue to track Canada's economic development on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.